right, let's talk about the equity method. If we own between 20% and 50% of another company, and we can exercise significant influence over that company, we should account for that investment using the equity method. My shorthand for that is their income is our income. So let's say we buy 25% of small company. That investment on our books will increase when we make the initial investment. It will increase when that company makes money. It will decrease when they pay us dividends, because we're going to act like dividends cash us out. It will also decrease when we amortize the excess that we paid over the book value of that small company. And also there's the issue of deferred gross profit. So let's talk about that before we go too much further. In the equity method, it doesn't matter whether the goods are sold upstream or downstream. We're going to defer part of the gross profit on those sales until they get sold to an outside third party. Otherwise, parent could just manipulate their income statement by forcing, since they exercise significant influence, the investee to accept sales from the parent to boost their gross profit for the year. All right, let's walk through an example. This thing will be much clearer when we walk through an example. All right, let's do a problem together. Let's read the first paragraph here. Harper acquires 40% of Kinman on 1/1/17 for $210,000 cash. The book value of the net assets of Kinman was $400,000. And what's happening is that $60,000 is attributable to the building they have that's really worth $100,000. And there's also a royalty agreement they have that's undervalued by $85,000. So let's stop there. First step in the equity method, figure out why we paid more than book value and figure out if there's something for us to amortize. So why did we pay more than book value? It tells us that we paid $210,000, so that must be what it's worth. That must be the fair value of 40% of this company. The book value is $400,000 for the whole company. We bought 40% of that. 40% of $400,000 is $160,000. So that means we have an excess of $50,000 that we have to explain. Well, the building was on their books for $60,000 but had a value of $100,000. That's an extra $40,000. 40% of that, because we bought only 40% of this company, is $16,000. The royalty is undervalued by $85,000. So 40% of $85,000 is $34,000. And there's nothing left to allocate to goodwill. So, well, since this building and this royalty have limited useful lives, we're going to have to amortize that extra bit that we paid above book value. So our total amortization, since the building is going to last for 10 years, the royalty is going to last for 20, is $3,300 every year. All right, let's look at the journal entries for this problem. First of all, we'll look at the journal entry on the date of acquisition, then the journal entries during the year 2017, then the journal entry at the end of 2017. So we buy this thing for $210,000 cash. Debit the balance sheet account investment in Kinman for $210,000. Credit the balance sheet account cash for $210,000. The problem tells us that the investee had a $40,000 loss in 2017. Their loss is our loss. So 40% of that will go as a loss on our books. And what we're going to do is we're going to decrease our investment in Kinman by that $16,000. So in this video, we're going to use red font for the income accounts. So instead of a credit to income like revenue, this is a debit to income, which looks more like an expense. So we decrease our investment in Kinman by that $16,000. That's our 40% of their $40,000 loss. Next, the problem tells us that the investee had a $20,000 other comprehensive loss. So maybe they owned some bonds of, say, Pacific Gas and Electric Company. They didn't sell those bonds, but they were classified on Kinman's balance sheet as available for sale. So those unrealized losses get included in other comprehensive income, important stuff that hasn't really happened yet. So that's going to go in our other comprehensive income. So we'll book 40% of that in other comprehensive income of Kinman on our books. So it'll show up and decrease our equity on our balance sheet, but not flow through the income statement, because Other comprehensive income, as I like to say, is other important stuff that hasn't quite happened yet. Next, the problem tells us that Kinman declared and paid $10,000 worth of dividends to all their shareholders. Since we own 40%, that means 4,000 of those came to us. So sometime during the year, we debited dividends receivable for 4,000, and we decreased our investment in Kinman. Remember, we act as if dividends cash us out of our investment, and then at some point we received $4,000 cash and credited dividends receivable of $4,000. Please note that the dividends do not flow through the income statement. So we aren't debiting or crediting any accounts in red font in this example. We're just decreasing our investment by those dividends. Lastly, let's do that amortization. If we had purchased 100% of Kinman, then our depreciation expense on that building and the amortization expense on that royalty would have increased dramatically when we put those things on our books at their fair value. So if we buy 40% of them, maybe they should also increase. And remember how we got our $3,300? We said that if we paid $50,000 above book value, we could allocate $16,000 of that to the building, which is going to last us for 10 years. We could allocate $34,000 of the royalty, which is going to last us 20 years. And so we knew that our annual amortization is $3,300. But rather than debiting amortization expense, we decrease our equity investee income by that $3,300 and decrease our investment in Kinman by that $3,300. So that's it for journal entries during the year. At the end of the year, we have to defer some gross profit. So Kinman sold to Harper stuff for $90,000 that cost Kinman $60,000. So that's a 33.33% gross profit margin. And at the end of the year, they still had not sold, Harper still had not sold $15,000 of that. So we're going to have to defer some of that gross profit because it has not been sold to an outside third party yet. So we'll take 33.33% times 15,000 times the 40% of Kinman that the parent Harper owns, and that means we're going to defer $2,000. Again, we don't debit any special account. We just decrease our investee equity and investee income by that $2,000 and decrease our investment by $2,000. And then when we sell that stuff at the beginning of next year, we'll reverse that out. So let's take a look at the 2018 journal entries. Let's say that on January 1st, they sell those $15,000 worth of goods, they being Harper. And so we finally get to book that deferred gross profit. So we increase our equity and investee income and increase our investment in Kinman by that $2,000 worth of deferred gross profit that was deferred at the end of 2017. During 2018, Kinman makes $40,000. Their income is our income. 40% of that is $16,000. So equity and investee income goes up by 16. We didn't make that money. The sub, if you would, Kinman made that money, but because we're using the equity method, their income is our income. We increase our investment in Kinman by that $16,000. During 2018, the Kinman pays out $12,000 in cash dividends. Remember, we pretend like dividends cash us out. So when they declare the dividends, we debit dividends receivable and reduce our investment in Kinman by our share of those dividends. 40% of $12,000 is $4,800. Sometime during the year we receive that $4,800, so we debit cash and credit dividends receivable. We also have to amortize that excess we paid over book value. Remember, we decided it was $3,300, so we reduce our equity and investee income by $3,300 and reduce our investment in Kinman by $3,300. Then lastly, on December 31st, 2018, we have to defer some gross profit. Kinman had sold to Harper goods for $80,000 that had a cost to Kinman of $50,000. That's a $30,000 worth of gross profit. Divided by $80,000 means that the gross profit margin is 37.5%. At year end, 30% of those goods are still left. 30% of $80,000 is $24,000. So we're going to have to defer 37.5% times $24,000 times the 40% of Kinman that Harper owns. So we're going to defer $3,600 worth of gross profit until those goods get sold to an outside third party. Okay, that's all there is to the equity method. Our investment in small went up when we made the initial investment. went down when they lost money, went down when they had another comprehensive loss, went down when they paid us dividends, went down when we amortized the excess we paid over book value, went down when we deferred gross profit from 2017 to 2018 when some goods were finally sold to an outside third party, went up with our share of their net income, went down with our dividends, went down with that amortization of excess over book value, and went down when we deferred gross profit from 2018 to hopefully 2019. And that's all there is to it.